Good morning, everyone. I'm Susan Seville. I'm the Director of Sales at FHLBank Topeka. We're pleased to welcome you to today's webinar, Preparing for Rising Rates, Balance Sheet Strategies in a Changing Environment. Our speaker today is Joe Kennerson. We welcome Joe back, have had him speak for us several times. He always does a great job. Joe is a managing director at Darling Consulting Group. Joe works directly with senior management teams on building customized balance sheet strategies to improve earnings and manage risk. Excuse me. Joe strives to be an expert in overall asset liability management. I apologize, my allergies are bad today, and educates ALCOs in the inevitable balance of financial performance and regulatory appeasement. In 2021, Joe spoke at 28 industry associations, and he reached nearly 3,000 bankers through those speaking engagements. He's an expert at helping bring clarity to the complex, and he delivers a high level of energy to his ALM presentations. Joe's been with DCG since 2005, and he has benefited from working with nearly 1,000 ALCOs throughout the country on ALM and strategic initiatives. Joe lives in Boxford, Massachusetts with his wife and 2 children, and he is an active member of Big Brothers Big Sisters. Joe is a graduate of the University of New Hampshire with a degree in finance. With that, I will turn it over to Joe to get started.
Well, thank you, Susan. I think I've got to trim down that bio a bit. And welcome again, everybody, to Preparing for Rising Rates. And here we go. We're off and running. Now, the good news is that rates have already risen, right? The belly of the curve has, sold off meaningfully over the past year. In fact, the 5-year Treasury rate as of this morning was knocking on, 240. And that's about 170 basis points higher than where it was in August, right? And so that's presented, some really good opportunities on the asset side that I want to explore today. I also want to explore what's ahead of us, potentially, right? Who knows, right? But I want to explore things like, what's going to be the impact to deposit pricing if the Fed really does get up to 2% by the end of the year, as the market is expecting. Heck, the market's now building in a 50 basis point hike in May and potentially another 50 basis points in June after Powell spoke yesterday. I want to explore things like, how do we want to maneuver our balance sheet, right? If the Fed tightens and the yield curve flattens, history will tell us that's exactly what's going to happen. And, it's happening now, right? Deeper on the curve. And also, and this might be a little bit outside the box, but what if, what if the belly of the curve doesn't hold up and this is a short-lived cycle? Folks, the 3 to 10-year point on the Treasury curve is inverted this morning. Right? And so how do we think about that in terms of how we want to position our assets and put our cash to work? That's a lot. Yeah, and I'm really excited to get into this. So let's do it. So I want to start here, set the table, ALCO realities, and then bring it back to some of the discussions that you're having at your ALCO meetings today. Of course, the deep-rooted theme is this Fed tightening cycle and the potential for a flat yield curve. Man, the Fed has got a tightrope to walk. Yeah, it's like, I feel like half the people are going to be like, the Fed's going to tighten so much, it's going to put us in a recession, right? And the other half are going to be like, well, the Fed's not going to tighten enough to deal with inflation. And I don't know if either one of those, probably not, end well, right? So how is the Fed going to land this thing? And you got so many forces at play here. Of course, inflation, right? That's the number one culprit for the Fed. Levels, the story, right? Levels you haven't seen in decades, probably going to go higher before it comes down. And the market and the Fed are signaling that they are going to get aggressive early on to deal with this inflation. Now, where it gets tricky is the Fed's going to be tightening at the same time of a war. Okay. And we know that, we know the impact that's happening. You've got spikes in prices and commodities in oil. You've got a stock market that's in correction, and you've got, a yield curve that's inverted, right? It's like, wow, how is this thing going to play out? So I really want to, strategize today with you, kind of break it down from each side of the balance sheet. Okay. On the funding side, we think of the tightening cycle as, rates going higher, deposit competition, higher cost of funds. And, as an industry, we have to be very sensitive to that today, given how low asset yields are and how tight margins are going into this cycle, much lower than going into previous tightening cycles, right? So again, the market's kind of indicating the Fed funds rate to get to 2% by the end of the year. Okay. We'll see. I think that's the market's way of saying that, the Fed's going to push this as much as they can before they invert the yield curve intentionally, theoretically, right? Theoretically, we don't know what's going to happen to the bond market over the year, right? Nevertheless, it is very conceivable that we're going to be up, to 125, 150 by the summer. Okay. And that's generally the time when deposit rates start to move. Right. CD specials start to come about. The spread on money market mutual funds and online savings start, and you kind of see the migration happening, deposits start to. So I want to be, proactive in this discussion with my clients on, how do we start to put together our deposit game plan? How are we going to manage all this liquidity that we brought in over the past 2 years? Again, I want to be proactive. And I don't want to be reactive, because that's when you see cost of funds starting to go up, when maybe more than they have to. Okay. I'll come back to that. On the asset side, things are trending pretty positively on the asset side today, right? Again, rates are higher. Even if the 5-year point stays where it's at, right? If rates continue to go up on the long end, ultimately that's going to be good for us, right? Even if they stay where they're at, asset yields are already starting to cycle higher. I'm hearing, loan volume picking up. We will be able to lag deposit rates, at least initially. And so we'll probably be in pretty good shape over the next year. So reminiscent of 2017 and 2018, right? But again, I do want to, listen, as a risk management partner for our clients, and I know we have some clients on the call today, we cannot dismiss the risk to earnings, okay, of this thing turning around down the road. And who knows when that means, or when that would be, but, of the belly of the curve coming back down. And that's one of the biggest risks for most institutions out there. And so again, given the fact that the yield curve is inverted today, do we start to, think about, buying some insurance and taking advantage of what's happened, to the sell-off in the belly of the curve, and really, again, buying some insurance from you kind of not knowing where rates could go, right? And I'm gonna get a little bit deeper into that. All right, now kind of level setting here, we are coming into this cycle in much different shape than in previous cycles, right? Just think about liquidity. Think about your loan to deposit ratio 5 years ago versus today. And I bring that up because there is a tremendous appetite and thirst out there to get, earning assets on the books, to get the cash, to work for us. We're kind of in this realization that these deposits are sticking around, right? And so for those of us that have been sitting on the sidelines on the cash side, who have 5 or 10%, of our balance sheet in cash, again, this is a really good opportunity. It's like we've turned around and all of a sudden we can get, bonds without credit risk at, close to 3% yields today. And a lot of us have our existing books at, yields at much lower than 2%. Okay. So there's been, again, a nice opportunity there. Even if we're fully invested in, and we're in a net borrowing position with the home loan bank today, it would be, worth considering a little pre-investment thought there. But I also bring this up because of, the demand to put more loans on the books. And this has been a topic that has really taken off over the past 2 months in our ALCO meetings. And I'm talking about loan competition and tight loan spreads. I will say that in the circles that I've been speaking in over the past, week or so, I've had, some pretty good discussions on healthy outlooks on the lending side. And maybe I'm just getting lucky with some of my conversations, but it does seem like there's some positive momentum there, right? But I come back to competition and tight spreads, right? Spreads on commercial deals are, extremely tight. And some of that's the product of the 5-year point moving so much so fast, and that will widen out, right? But again, given how much competition and the need to put on, loans on the books, does that put a cap on spreads today? When I talk about spreads, I'm talking like, commercial real estate deals, for example, we're seeing still hitting the books at, FHLB minus 2%, type of levels. Again, that will widen. It has to, especially when you've got, GSE bonds, kind of yielding around 3%. So that'll get pushed up. Another thing that we're hearing is you have borrowers kind of knowing what's going on out there, and in knowing that the Fed is going to start, is tightening, and there's that demand that's picking up for 7 to 10 year structures, right? And so there lies another dilemma that I'm hearing at a lot of ALCO. Should I be putting on, this type of long-term paper at these tight spreads, even if I love the credits, on my balance sheet today? And, am I saying no to deals that I probably should be saying yes to? And that's a real tough one. And then finally, of course, deposit management is back in view. And I bring this up because coming into this year, when we were building our budgets, the expectation, was that the Fed was going to raise rates 3 times. And so a lot of our clients building out their budgets. Hey, Fed's going to go up 3 times. I'm going to lag, and I'm not going to adjust my, cost of funds at all in my budget. Now, all of a sudden you got, 8 Fed hikes in the purview of the market. And so again, this is a conversation that's really picking up steam today. So this is a lot to talk about in an hour. I do want to try to compartmentalize this and focus on 3 key areas today. Number one, keep cash at work. And you're probably thinking, Joe, I had to come to a webinar for you to tell me to keep my cash at work. It's like, no, I mean, I really want to, especially given how much the belly of the curve has sold off, really want to have a defined strategy for my excess cash day when you get to your next ALCO meeting, right? And if you just had your ALCO meeting, maybe we've got to schedule a special ALCO meeting. I actually sent out emails to all of my clients this morning talking about, strategies and excess cash. I also bring this up because I hear a lot that, listen, I was very active on the bond side over the last year. I want to focus now on shifting investment cash flow and cash into loans. I get it, right? But how plausible is that, right? And what would that forecast look like over the next year or so? How long would it take for me to really absorb my cash and loan growth? And should I take action, take advantage of this, okay, the slope of the curve today, right? And go out and get a head start on earnings. Number 2, develop your deposit game plan. I know everybody's first step to their game plan. It's lag as much as we possibly can, right? But I want to talk about steps 2 through 4. Okay. Here's a question to ask your group. And we ask this to a lot of our clients. And I think it's a real challenging one, which is, again, given how much liquidity we brought on over the past 2 years, all this deposit growth, okay, how much of that liquidity are we willing to part with before we get more offensive on the deposit side? Because I hear it all the time, I'm going to lag 75, 100, right? And that can help, again, craft some of our, our steps, because this competition is going to be in front of us, faster than we're used to seeing rates move. And then finally, define fixed rate capacity versus appetite. I know everybody's appetite, especially in the early stages of a tightening cycle. Like, I want to keep my loans short with healthy credit spreads. I get it. I wish I had thick flowing hair like Bradley Cooper. It's not in the cards for me, right? Especially with what the market is asking for. So, I think this is a tough conversation to have with the board and your ALCO and your team of saying, should I be putting on these type of fixed rate loans at these spreads? And what is my capacity? What type of bucket can I fill? And by the way, given the outlook and the earnings risk, for most of us out there, might be the best move today. Okay, so we're going to sink our teeth into this. I keep talking about the yield curve. You kind of think about, everything that's happened. Take a look at the yield curve year over year. Okay, blue was last March, and then orange is basically yesterday. And when I talk about the belly of the curve, right? I'm really talking about that 3 to 5 year points where we price a lot of our assets, and you could see how much that's moved. Okay. So on the lending side, I bring this up in the context of, again, 5 year points moved up 170 basis points since August. How much has our loan pricing reacted to that? And I don't expect loan pricing to move lockstep with the market, but are we getting pricing power? Are we a leader in the market to really start to push our rates higher? And again, they have to, if you're looking at bonds. If you're still seeing deals, on the commercial, the ag side, and with a 3% handle, those have to move higher because of where investment yields are, have been trending. Okay. So I also bring this up because of what I've been mentioning, which is, this slight inversion of the yield curve 3 to the 10 year point, right? It's only a basis point or 2, but we all know what an inverted yield curve can signal. Okay. And, for the lack of, trying to predict what's going to happen, that again, the thought here is this type of slope that we're seeing today, should I be out here and taking advantage of what's been trending on that belly of the curve? I mean, and again, buy some insurance against this coming back down. Do I think it's going to happen anytime soon? Probably not, right? But who knows? Like, who knows what's in store for us a year down the road beyond that, right? I said to clients this morning, I think this would be a good, strategy with some of our cash. And by the way, if we execute, I hope the rates continue to go higher. That ultimately should be good for our business and trending of asset yields for the rest of our balance sheet, right? And so there's obviously an infinite amount of different iterations that we could look at, but I'll show you a couple of case studies today. But then ultimately, we're trying to figure out like what's happening on the short end, right? And again, nobody knows. I think we're all in the camp here that the Fed's going to be aggressive, as much as they can over the next 6 to 9 months. But again, we don't really know, what's in store for us down the road. And the good news is we're not, supposed to know, right? And I think in an environment like today with so much uncertainty, just look at the dot plot for the end of 2022 and how much uncertainty the Fed members have, right? I think we got to digest this information and make decisions based upon who we are. Listen to our balance sheet. That's one of the mantras we have here at Darling Consulting Group. And what I mean by that is I onboarded a new client to our advisory service. So we build the model every quarter, meet with their team, talk strategy like we are today. And, one thing the CEO said to me is like, what I like about the process here is that decisions are based more on data and facts and less on gut, right? What is our risk profile telling us? And what should we be doing accordingly, right? So what is our data telling us? And when I'm talking about data today, I'm talking about deposit data, okay? A lot of us have seen 30, 40, 50% growth in non-maturity deposits, over the past 2 years. What do we know about it, right? What's our storyline if somebody were to ask us, what happened, where it came in, and how do we think it's going to play out? How can we tell that story? How confident are we in our assumptions? Almost 90% of all deposits in our space reside in non-maturity deposits. We have to dictate what those assumptions are in our risk models. And I bring this up because frequently I see pretty conservative non-maturity deposit assumptions in the model, right? I'm talking to prospective clients like, hey, you got some sensitivity to rising rates. How are you looking at this tightening cycle? Oh no, don't worry about that. We're going to lag rates, a decent amount. So we don't really listen to that. It's like, well, should we be incorporating that into our discussions, our strategies, our risk models? And then once we get all this stuff together, how are we dissecting it? How are we looking at scenarios to support decision-making? Are we looking at what we have to do, like shocks, or are we running pragmatic scenarios? I'm talking to a $2 billion shop down in Texas, right? They only look at shocks. Now, this might be one environment where shocks could be considered pragmatic. I still don't think it's worth looking at. But everybody here should be running a rising rate scenario ramped with a flattening of the yield curve, right? And I'm assuming most of you are doing that. So the point is we have to get this right so that we can get to the ALCO meeting and talk less about where we've been and talk more about where we're going, right? And leave the meeting with executable strategies. Take our ALCO on a journey to get there. So first stop on the journey with you today is going to be on interest rate risk, talking about bringing some clarity to that. And what I mean really is that number one, interest rate risk positions have changed materially over the past 2 years. I'm going to show you some data on that. And number two, you may be making decisions today that could run counter to what one would deem as this is a rising rate environment. Why are we doing this? You're filling a bucket on 7 to 10 year commercial deals, or you're willing to let liquidity leave before we get aggressive on deposit pricing. So how do we create that narrative, right? So before we do, I'll take a little breather. We have a polling question. If we can launch it, Jesse. We're going to have 2 polling questions for today. Okay. The first one here feeds right into interest rate risk sensitivity. It is very timely, especially with, Powell's comments yesterday, which would be how much more Fed tightening would have to happen until you start to price up money markets. And I'll exclude public funds because public funds are really, there is no lag in the market. They tend to price pretty consistently with the Fed hikes. Is it, another 25 basis points, another 50, another 75, or the Fed's really got to go up at least 100 until I start moving some of my money market rates. Again, I saw it, this morning that the market is pricing in a better than not probability of a 50 basis point hike after Powell's comments yesterday. Powell really opened the door for that. And that at I think it's the May 5th or May 6th meeting. And then there's also increased probability of another 50 coming in June. So they're definitely looking to get a head start here. So Jesse, with that, let's go ahead and we'll close out the poll. And I'm interested in, we've got a lot of attendees today. So hopefully you all can see this. 14% said, 25 more bips. 46, almost half of you said there's going to be another 50 from the Fed. And then about 40% of you said 75 or 100 plus, right? So 60% of the people here think that it could be the next Fed meeting when money market pricing really starts to take off. And that's why we've got a big focus on that today. So thank you. All right. So, kind of getting back into this, my goal for today is to leave you with some action items and ideas to bring back to your ALCO. So I've got stuff like this sprinkled throughout, action items, takeaways. On the interest rate risk side, I talk about recharging your deposit assumptions. So I mentioned deposit assumptions earlier. Here it is again, and I'm going to come back to it because it is that important. And I think about all the deposit surge and what is your story, right? What is your story? We've got, if you're a credit union, you might think that, or might see that, all of your deposit growth, was really spread through your entire demographic base. There might be commercial banks that said 80% of all my deposit surge over the past 2 years happened in accounts over 250,000. What's your story? And how do you think that's going to play out when the Fed does go up another 50 to 75, right? Talk about dynamic betas. And the thought there is, your deposit betas are going to be a lot more muted in the first 100 basis points of Fed tightening versus the second 100 basis points of Fed tightening. And so is that incorporated into your analysis in your strategy discussion? Deconstruct rising rates. So I'll talk a little bit about dynamic betas and lag factors, and also looking at, twisting the curve and looking at a flat rate scenario. Run pro formas. If you stick with me today, towards the end, I've got a cool case study that I ran for a client last week that looked at dynamic betas and then ran, a commercial real estate loan strategy funded short to see the impact on the risk profile. And then just take caution on antiquated tools. And I mentioned shocks and not looking at graphs and things like that. I think a lot of us are past that. But I mentioned earlier that, risk positions have changed materially over the past couple of years, really post-COVID, post-stimulus. Here's some data from our client base. So this is looking at net interest income sensitivity factors from the end of 2019 to the end of 2021, okay? So you can see that the number of asset-sensitive clients, so asset sensitivity means that our earnings do better as rates rise, okay? Back in 19, we had about 40% of our client base were asset sensitive. Today, that's 70%. So that's like a monumental change. And this is not a small sample size, okay? This is over 300 models, right, that we run on a quarterly basis. And that sensitivity really changed by 2 full percentage points. Here's an example, okay? And I know this is just one example, but sometimes the pictures can tell a story. This is a client that I've been working with for over 16 years now, okay? If you look at the graph over to the right, this was their net interest income position back in 2019, pre-COVID. So I got to level set a little bit here, what we're looking at. First thing, I talk about antiquated tools. We like to look at graphs, okay? So you can see trends and inflection points. You're looking at a 5-year simulation. We're making decisions today out on the curve today. I want to see how everything cycles through the balance sheet. The bar graphs represent the base case, okay? No growth, no change in rates. How are things trending today? The dark blue line is down 1. Hopefully we don't go back there anytime soon. And then the orange line is an up 2 ramped over a year, kind of consistent with the futures market. Okay. And so for 16 years, or I should say maybe 14 years, this is what this, institution looked like, right? It's like they've got some sensitivity to rising rates, and it's a common, risk profile, for a community shop where I don't have a lot of floating rate loans, but I don't have a lot of really long-term loans. And I've got some money markets, maybe some CDs or public funds that price up near term. That's where I get that pinch, but then I get that asset cash flow that catches up, and that's the recovery. But here's where they've trended over the past couple of years. Over to the left is what they look like today. It's like, they kind of look like a commercial bank now. And so the point of bringing this up is not that I don't buy into this, I don't believe this, is that this risk profile still exists somewhere in here. And this is really driven for them by 50% non-maturity deposit growth, decent amount still sitting in cash. What's our story, right? How do we tell that story? And again, that story comes back to really understanding the deposit base. Okay. So I talk about recharge deposit assumptions. I'm thinking of stuff like, more strategically too, disintermediation assessment. How much of your CDs, those of us had meaningful CD books, how much of those CDs shifted over in non-maturity deposits? By the way, those are going to be the first to move over the next few months. It'd be important to get a list of the top 20 there. CD betas, if rates go up 100 basis points from here, it's likely that CD specials are going to be the norm, and it's going to price close to the market. Do your models reflect that? Have average lives been impacted, especially on the credit union side? This is critical. You know why, right? And if we adjusted this for all of the deposit surge, and then finally dynamic betas, okay? And I come at the dynamic betas mainly for, again, thinking about some of the strategies that we opened up with and talked about. So let me, use some data to kind of like set this up. This might be a nice little insert, this slide here, into your next ALCO discussion. This is looking at the deposit betas over the last, 2 rising rate cycles. Okay. So, the black dashes represent the effective Fed funds. The blue line is the cost of non-maturity deposits. This is for our client base. Okay. Again, over the past 2 rising rate cycles, you go back to 0407, the Fed tightened 425 basis points. Okay. I've got it boxed in green down below. You can see that non-maturity deposit betas were about 35% through that cycle. Right. So deposits priced about 35% of that 425 basis point market move. That's the beta. Okay. Now that was not linear. In fact, I broke down different segments here. You can see for the first 125 bips, it was somewhat muted. And then the sensitivities really picked up on the back end. Okay. Let's go to the last rising rate cycle. It was spread out. We know 15 to 18. It was really end of 16 to 18. The Fed moved about half of the previous cycle. Well, the beta was about half of that, 17%, boxed in purple here. Same deal, right? For the first 125 basis points, very muted beta. And then as we know, things picked up at end of 2018 and even into 2019 when the Fed was done tightening. So of course we bring this up because we're thinking about what's ahead of us. And I'm going to give you a little purview into some of our predictive analytics. We do a lot with data here at Darling Consulting Group. And so we're thinking about, what's ahead of us. And so here's us projecting it up to over the next 24 months. And, you can see the sensitivities that our predictive model is suggesting. It's like, okay, in that, expecting, a deposit beta of 22%, but you can see similar lag factors in the previous rate cycle. So, you're probably thinking, Joe, I kind of get this. This is like, I would expect it. My question is, how is this being incorporated to your modeling? How is this being incorporated to your decision-making? And how comfortable you are with filling a bucket on fixed rate loans or putting cash out on the curve. Right? So again, I'm going to show a case study later on to really tackle this, but something we're thinking about and exploring with your data. When I talk about deconstructing rising rates, this is kind of what I'm talking about. And so what I've displayed here are a set, actually 4 different up 200 scenarios with different characteristics. And they kind of tell their own story. And so it's why it's important, number one, as I mentioned earlier, to look at graphs. Because sometimes if you're just looking at percentage changes in year one, it's not going to tell the whole story. And I'm talking about shocks. Okay. So look at the black line, right? This up 2 scenario. And for those of us that have just a smidge of sensitivity to rising rates, we know that's going to be exacerbated in a shock scenario because you're going to get that immediate, pricing up on our non-maturity deposit base day one. Right. And so if I'm, this shop and I'm only looking at an up to year one sensitivity, I'm going to say, oh, it's minus 3%. Oh man, that's, I got rising rate exposure. I got to shorten up my assets, lengthen my liabilities. I lose perspective on this trend and see how fast this thing shoots up. Right. That's why it's also important to look at ramp scenarios. You can see the orange is a 12-month ramp. Okay. The purple line is more of a gradual ramp. But all of us have to focus on a rising rate scenario with a flattening yield curve today, especially with that, 3 to 5 year inversion that we're already seeing today. And you can really see the juxtaposition between the parallel shifts and the flattening of the yield curve. And so if we're talking about our ability to, again, to, go out on the curve How much does our balance sheet, our existing balance sheet support that? Or do I need to add protection? So it's an important journey we need to take with our ALCO today. Okay. Critical that I continue to mention this. Okay. Interest rate risk is not always about looking just at rising rates. And it's easy to, just have a focus. The title of the webinar today was for preparing for rising rates, right? But again, seeing how aggressive the short end of the curve has been, we cannot dismiss the risk to earnings if long-term rates fall. Do I think that's going to happen? I don't think my opinion matters. Could it happen? Yeah, it could. Who knows when? One thing that does have me a little concerned is if I think down the road, as I say, we go through this tightening cycle. By the way, the futures market is already building in a Fed cut end of 23. Okay. Say we go through the cycle and we lag more than we usually do because of all the liquidity in the system. Great. What happens when the next cycle turns around and you have limited ability to reduce funding costs? Right. So, the point here is that if we're listening to our balance sheet and we're looking at our risk profile and falling rates still represents the worst case scenario for us, how are we talking about that at ALCO? Had an ALCO meeting last week. Clients got, 4% exposure to the flat up 2. One of my key takeaways for the meeting was that I'm still more concerned for them on the longer term risk of rates down versus rates up in the flattening of the yield curve. They have a lot more flexibility with their balance sheet, a lot more maneuvering they can do, right? Especially given how much liquidity they have to manage through that. Tricky one today, right? But we're all, you're coming back to this. We're talking about this flat yield curve today and this dilemma. Here is a history of yield curve shaping over the past 40 years. The red line is the effective Fed funds rate. The blue line is the 2-10 Treasury spread. Generally a barometer of the health of the economy or the future of the health of the economy, right? And so you can see like clockwork, right? Every time the your red line goes up, the spread flats. Okay. Oftentimes, the spread, or the yield curve dips negative, inverts, right? And then that precedes what? The gray bars, which represent a recession. Okay. And so we bring this up today, for a couple of reasons. Number one, 2-10 Treasury spread's already at 20 bips. One Fed hike. Okay. You also think about this in terms of learning lessons, particularly on the asset side, right? If say this, it's got to paint a picture. Say the Fed does go up 2% this year. We're here, in December. We're talking about this again. Yield curves like this. I've still got some cash on the balance sheet, yielding 2.25 at the Fed. And now I'm looking at a flat yield curve, and investments are only getting me an extra 25 to 40 basis points. Your gut is telling you that, what? I'm not going to go and add this extension risk out on the curve. I'm going to stay short. That's a time, okay, when you want to do the opposite, because this is a signal that this is happening. And so that's when we have to be very disciplined with some of the decisions on our balance sheet. And that's when they become the toughest. Okay. Okay, shifting focus here, keep cash at work. Some thoughts on the investment side. Clearly I've been active here. It's important for me to say that I talk a lot about investments. I've got a whole section here, cash deployment, buying insurance against rates going down. We do not sell bonds here at Darling Consulting Group. We're not a broker dealer. We're not an investment bank, right? So we are 100% independent. Send out those emails to my clients today. We don't make a penny off of these trades. It's because we're thinking about balance sheet risk and what we think is the best fit for our clients, balance sheet and risk position. So I talked earlier, I think a really healthy, if we're challenged with our team of getting cash to work today, a healthy exercise would be, let me do a liquidity forecast, maybe a couple of different ways with different deposit paths, and say, given my loan expectations, how long would it take for me to really, again, sop up all my cash through loan growth? And that can really help carve out how much cash I think I want to put to work today. Formulate our bonds. This is a tricky one today. Formulate the strategy with the entire balance sheet risk, not just the transaction. So some of us might be thinking, Joe, I'm just going to focus on 2 to 3 year Treasury bonds because that part of the curve is here. It's like boom, and then it flattens out, right? So I'm going to take advantage of that, and I think that might make sense for a lot of us today. But what if I've got a relatively short loan portfolio and a real strong core funding base? I'm asset sensitive as the day is long. Maybe I should be taking my investment portfolio and offsetting some of that risk. Maybe I should be looking at 5 to 7 year treasury bonds with some discounted MBS paper, right? I can't give specific bond strategies today because it's not fair. It's going to be dependent upon every balance sheet and risk profile, but really want to think about this from the total balance sheet's perspective, right? And not just the transaction. I like to simplify it by thinking, okay, how much cash do I want to, really keep handy today and fund loan growth with? How much do I want to kind of put in that 2 to 3 year bucket, right? So maybe there is an element of that to say, I want to start shifting my asset mix 2 to 3 years down the road. And then how much do I want to allocate to really where the yield is out long, okay? Not everybody here is sitting on cash. Got plenty of clients that are at a purchase position with the home loan bank, okay? I had this discussion recently with a client, and they're pretty active on the bond side. And so now their goal is to shift their mix. They want to shift investment cash flow into loans. And so I challenged them at ALCO. I said, listen, we can now get 2.5 to 3% on investments. Your average portfolio yield is 160. What are your thoughts at, maybe doing some pre-investment, taking a look at 6 months of cash flow. We got $20 million coming due. What if we borrow from the home loan bank today, go out and buy securities at higher yield, get a lift there and a head start, okay? And then we can figure out how we want to fund that loan growth, right? And we may want to, maintain that leverage and continue to fund loan growth with deposit growth, or maybe shed off some of that investment cash flow. We can kind of navigate that as the market, runs through its progressions here. The best case scenario for some of us might be to be at a borrowing position, later this year, right? And think call protection. So I keep kind of, talking about treasury bonds. It's a simple one today of buying protection and not having the bonds called back if rates do come down. And then ultimately, we've got to be able to tell our story. We got to create our narrative today, right? We were talking about this last year for our clients on unrealized losses, okay? This is going to be a big topic. You're going to see a lot of articles and a lot of mentioning of this, especially when the Q1 data hits. Bonds that we were buying, 2021 was a very active bond buying year for the right reasons. Bonds that we were buying then are now, 100 to 150 basis points higher today. So we're going to see material unrealized losses on the balance sheets. What's our story behind that? How are we talking about that? We need to continue to talk about that because there still remains a big opportunity cost in sitting in cash today, right? And part of that conversation might be, unrealized losses. That might be a good thing. And you kind of say that tongue in cheek in the fact that, that means that rates have gone like this and the prospects for earnings have gone higher. I'm just thinking of net interest income simulations that we ran for our clients last year. The projections were like this when rates were lower because loans were getting walloped. Now our projections are flat to, actually up. So it's a better outlook overall for our balance sheet. And I know there's some tangible capital that we've got to think about. And I'm assuming if that's an issue, then you're allocating HTM to some of the long-term paper, right? But if we're thinking that unrealized losses are bad, that then means unrealized gains are good, right? And I think back to, again, summer of last year when the 5-year point was under 80 basis points and the outlook for margin was really scary. I did, webinar here, right? And it was really scary. And so now it's like, but we had big unrealized gains, so kind of bringing some perspective and doing analyses like this. This is a tool that we've offered up to, we started building for clients. And again, I know we've got some clients on the call today. If you haven't seen this, don't yell at your consultant. It's probably coming at the next ALCO meeting, but it's a tool to arm finance with, to say, here's why I purchased those bonds. There was a reason why, right? I was protecting my earnings with the opportunity cost that was on my balance sheet. I was protecting my earnings against rates staying low. And then, so let me just kind of go through an example here. Here's a client that in 2021 bought about $92 million on average of investments throughout the year, average yield of 142. Brought in $1.3 million. Okay. If we were to stay in cash, well, we would have brought in, $92,000. Okay. So the net pickup versus cash with this strategy, was $1.2 million. So I'm hearing the Monday morning quarterbacks. Oh, we should have kind of, why were we out there, when the market was so down? You can buy those same investments today at 250, 275. It's like, well, okay, fine. I mean, obviously there's an element of timing the market, which is impossible, as we know. But, there's also the opportunity cost discussion. But even if we wanted to have that talk, right, then let's have that talk and say, well, if I wanted to go back, say I wanted to kind of, I could time the market, right? And if that's the case, I gotta make back the $1.2 million of pre-tax net interest income from last year that went to capital. And then I got to make, another $1.3 million for 2022, because that's what this book is projected to make for the next year. If that's the case, I would have to take this entire $92 million on January 1st, right? And go out and buy securities at 274. Now we can get 274 today. We can, right? But that would mean putting all of it to work far out on the curve, right? And so the point is, here's why we did what we did. And here's why ultimately rates up is a good thing for our balance sheet. And guess what? This conversation lives today. I got to update this chart, right? This conversation lives today. There's a big opportunity cost in sitting in cash. Now, we know that opportunity cost is going to squeeze when the Fed, tightens and the yield on cash goes higher, but still, you see where you can see where investments have gone. Fed funds would have to average a very high rate over the next few years to eat up that opportunity cost. Here's a way I've attacked this for one of my clients, and looking at longer term versus shorter term, strategies. What do we think is the best fit for our balance sheet? So here's a client that, well, let me kind of level set this. This was their risk profile towards the end of last year. Okay. Net interest income, 5-year graph. Here's a set of 2 rising rate scenarios. The up 2 ramped over 2 years. Okay. And then the flat up 2. Okay. So you can see that if rates go up in a parallel fashion or flatten, it doesn't matter. They're gonna do better in a rising rate environment, versus this is really what we're trying to protect. So this is tricky, right? Because I know rates are going to go higher, but do I take some of this opportunity cost off the table, opportunity benefit, I should say, off the table to protect this and kind of squeeze up this risk profile? And that's interest rate risk. So, this balance sheet has about 50 million in cash. So we thought, okay, let's do a barbell strategy, take 20 million of that, keep 30 in cash, and go out on the curve. So I'm not suggesting specific bonds today. It's impossible to do that with 100 people on the call, right? In this case, we looked at 20 to 25 year MBS. At the time, spreads really widened out. We could look at some discounted paper. You could pick up a lot versus, obviously cash today, which will tighten. But you can see, again, over to the right is kind of their status quo. Over to the left is that barbell strategy. Now you might be thinking, Joe, you screwed up the PowerPoint. Pictures look exactly the same. That's kind of the point, right? It's that, $20 million might be a big, chunk to take a bite out of today, but it's, 2.5% of their balance sheet. It is not going to flip their risk profile. So what type of earnings can I bring in, get a head start in 2022, protect rates from going down, down the road, right? Obviously there's some call risk here. If we're buying them at discounts, there's that benefit, right? And what's the pickup in this case? Picking up a nice spread and actually even do better as rates rise overall. I wanted to juxtapose this to, well, what if we stay a little bit shorter, shorter duration? I want to ride this thing up, as the Fed tightens. So to get the same spread out of the chute on net interest income, I'd have to do 29 million of extension, not 20 million. And in this case, looking at 10-year MBS, right? So realistically, you'd probably look at 2 to 3 year bullets combined with some MBS paper, right? So really where I want to take you on this one is, the ultimate goal here is, how do I get to a point of decision-making? Strategy execution. So here's a side-by-side comparison. Over to the left is the barbell strategy. Over to the right is the shorter duration strategy. Base case, we're out of the chute, same spread today. But what we found interesting, if you look in the change in results down below, right? The barbell strategy actually wins out in the rising rate scenarios because of, keeping more powder dry and the higher spread on the transaction today. So the point is, how are we navigating through this, looking at various options, running the pro formas, doing the side-by-side analysis, and we leave the meeting with executable strategies. Okay. Deposit game planning, wish we had another hour. With that, let's go into our next polling question. I'm going to take a breather over here. Thank you, Jesse. What's your first move? Some of you might have already made it. Okay. What's your first deposit move? Is it going to be selectively pricing on the squeaky wheel, which is that exception pricing? That was the big 2017, 2018 strategy. Are we going to be offering a special money market or CD? Are we just going to move existing rates on the products that we have? or not sure. We haven't really talked about it ALCO yet, right? Every time I have this conversation, it feels like we're getting closer and closer to that point in time where we're going to have to start, we're going to be making these decisions. So with that, Jesse, let's go ahead, and I'm very interested in seeing the results here. Okay. Wow. Yeah. So I did a similar webinar about 3 weeks ago. 60% of the people said A. And look how much that's changed. And I can't help but think that that's changed because of how much the market expectations on Fed tightening have changed. So 19% said exception pricing, 24% said offering a special, 41%, going to move existing rates. So I got some thoughts there, and almost 20% saying haven't really kicked this thing around. If I have one takeaway, it's hopefully to get you some ideas to at least start, game planning on the deposit side. So let me start here. I'm gonna just throw a lot of stuff out there, just questions to ponder, ideas to bring back to your team. Hopefully, I asked a question earlier, which was, how much liquidity are you willing to part with before you start to be a little bit more offensive on the deposit side? Because I constantly hear lag, I'm going to lag 75, I'm going to lag 50, I'm going to lag 100 basis points. How does that really play out when the rubber meets the road? Right. So this dovetails into how much do we think we can lag? What did we lag in previous cycles, and how much lag capacity do we have? Once we have that conversation, we then need to face, well, how are we going to react if, our biggest competitor comes out with a CD special at 1.25 next month? Okay. Some of the big online players are already there, right? Goldman's Markets at 110. A couple others are up there. Okay. How do we react, right? Do we have a product on the shelf? Are we going to be more defensive? Are we going to have that, selective pricing strategy? How have we coached our front lines in having these discussions with some of our biggest customers and members, right? I come back to thinking about what is our offensive strategy? What's our defensive strategy? Offensive being, I've got something, maybe for some of us, is I've got something on the shelf ready to go if liquidity all of a sudden becomes an issue, right? And deposit rates are moving up aggressively. And how does that product differentiate from your existing product set? How have you created specific hurdles and obstacles so you minimize cannibalization? I'm talking to I talked to a brand new client last week. They're going into a new market, right? They're out in Idaho. They're going into the Boise market, right? So how can we create a product that really brings in, folks on new money growth on the defensive side, right? A lot of that today is, do we understand all the CD customers that are sitting idle in non-maturity deposits? How have we, stack those up? If we're going to be doing exception pricing, who wins, right? Obviously we're going to have a different pricing strategy for a single source CD customer versus a more developed customer that's got a loan on the books, right? How have we kind of, itemized those strategies? And I think for a lot of finance folks on the call today, how are you armed with these discussions, right, to have those type of, synergistic conversations with your retail and relationship team? This is going to be the big concern second half of the year. The biggest risk to margin in a tightening cycle is right here, deposit cannibalization. We saw it, we track all this stuff. We saw it, really take off in 18 and 19. Because it took us would it take us a year and a half to go up 125 basis points on the Fed, on the Fed side, last tightening cycle? We might get there in 3 or 4 months. Right. So how do we develop products, for, I forget what it was, 40 or 20 to 40% of you saying, special products. How are you going to create that product to minimize cannibalization? Is it just going to be, I'm going to be in the top third of the market and $5 minimum balance, or is it going to be something different? Okay. For those of us, the majority of you said, I'm going to price up on my existing deposit base. I want you to take a very close look at your tiers, and you may want to consider rebalancing before you do that, okay? Because all of this non-maturity deposit growth that is coming to the system, it might have thrown your tiers out of whack. And I'll give you an example. Public deposits, that's a really tricky one today. I'll give you an interesting story here. I've got a client that's at a purchase position. They're borrowing from the Home Loan Bank today. They had an opportunity to bring in a brand new public deposit relationship that was, a big balance, a lot bigger than what they generally hold. And, the city was asking for 60 basis points plus insurance. I'm like, we're way better off going to the Home Loan Bank, right? That's just it's like, what do we, why would we pay up for that today? Right. So, They said, nope, sorry, it's just too much money. At the end of the day, they got the money, but they got it at 30 basis points, right? And so how much, pricing power do we have given the liquidity on in our system today? And we got to be able to track data. I guess my big point here is, how are we making decisions today? How are you making decisions on deposits today? Here's another really important takeaway. And I've had a lot of, CFOs and CEOs say this is really important to kind of show all the business leaders and the frontline business lines, this type of analysis. Everybody can do it. This is actually rather simple. So quantify the net interest income impact from, the Fed going up by 50 in May, right? You could do 100, if you want to capture May and June, you can do whatever, right? But the point here is I wanted to see contractually, right? All the assets and liabilities that are tied to short-term indices, what's the annualized impact to net interest income? And I want to hold deposits flat. Just keep that flat for now. And you can see the pickup for them is about $1.7 million. The next layer I want to get into is then to say, all right, now our model is built to have deposit betas, right? We're telling the model to say, all right, rates go up 50 or 100 or 200, move deposit rates, by X. So now I, enabled the betas to see what that impact would then be. What was interesting is they went from a positive $1.7 million of net interest income in year one to a negative $1.7 million. So a $3.4 million delta, which really highlights the importance of needing to, lag as much as we can. And again, I think that's important for the entire team to see. Now, the majority of you, again, on the polling side said that their first move is going to be pricing up existing products. I'm assuming money markets or premium savings, whatever the case may be. This is why it's important to look at. Okay, so this is data aggregated from our client base. Okay, looking at money market tiers. So this is pretty cool insight into some, there's hundreds and hundreds of clients. So these are all our money markets, accounts, balances broken out by tiers. So what you'll notice is that only 13% of all client balances in money markets are in, accounts less than $100,000. By the way, you can see some pricing trends. So my point here is that if you do have legacy tiers established, and I'm seeing this less and less, but this is still out there. If, a common legacy tier structure would be my top tier is 100,000 plus. Well, if your deposit, your money market mix is anything like our average client mix, 87% of all the balances fit into that top tier. So we don't have a tier product, right? And what's the tier that you're going to move first and the most? It's going to be the top tier. So this would such an easy takeaway, such a simple takeaway. Say, I want to restructure those tiers today before May comes and the Fed goes, up again, so that I have more flexibility on pricing. In fact, what we find is you can price even higher than you would expect on the top tiers while maintaining your deposit betas. Simple takeaway. So I talk about cannibalization. This generally I've been saying this is kind of end of the year going into next year. This is probably going to be a big conversation sooner rather than later. And it's all about the element of, I've got this promo out there. Okay. I think 20% of you said, doing a promo. Where's the growth coming from? How successful is it? We track all this stuff through our Deposits 360 module. Okay, so this is an example. It's a real life case study for a client that went out early last cycle. So they opened up a money market special March of 2017. Okay, you can see that the rate offering was just 50 basis points, so low at the time, but still higher than average. They brought in $50 million over the year, right? So again, we want to know the sourcing of that growth. Over to the left tells that story, right, from our module. So the green is the good stuff, the money from new, customer dollars or existing, customer dollars. The blue bar is what we all want to know, what we all need to know, which is the cannibalization. So in this case, you grew almost $50 million, but really half of it was cannibalized. Yeah, but that's not the full story either. Well, all of that cannibalization, most of it came from legacy money markets. I was already paying 36 bips. They were probably going to trend over anyways. But the important thing here is that the marginal cost of the new money earned, sure, it wasn't 50, but it was only 65. Real home run strategy. And so for those of us, and I've talked to these type of institutions that, Joe, I've got a 15% loan growth outlook over the next couple of years, right? I'm looking to make a splash, or we're working with, 4 or 5 de novos right now, and their strategies on opening up the doors. And so if we're out there and we're feeling a little bit differently, early in the cycle is generally the better time to, gain some new core relationships, right? And so thinking about, relationship-based products, if we're going to be aggressive on money markets, how do we get the linkage of checking accounts? That story, right? How do we really package that together? New money, right? New money is one of those polarizing topics. Some of you just like, Joe, don't even talk about it. But if you're going to be doing a special, I would at least throw this on the table of your next pricing meeting. I'm not personally a big fan of new money only, but I've seen some very successful new money match, new money mins of strategies here, saying that for existing customers that come in and say, I really like that, shift over 50,000. Sure, happy to do that. You just need to bring in another 50,000 of new money. And I've seen it being very well received, from the community, and very successful in saying, I know cannibalization is not going to be zero. How do I avoid this? Right? How do I avoid this? 70%. Right. And, this is another CD special, same time, $1.25 or $1.20. And this is really what we're concerned with, during this tightening cycle. So how do I really focus on bringing these cannibalization levels down as I offer up these products? Okay. Define fixed rate capacity. So, I wanted to have a section here because, this has just been coming up a lot in ALCO meetings, with tighter spreads. It's like, man, these really nice credits. I just, 375 or 4%. Or I've got this, how would you deal with this? I got this, really good credit, but they want a 10-year deal at 4.25, right? And it's like, man, the rates are going up. I feel like I shouldn't be, should I be putting that on the balance sheet? And so that's why we talk about capacity versus appetite. The appetite might be zero, but really what's our capacity? So I've walked through that kind of cycle of, showing you some, some risk analyses. I'm going to show a case study of a pro forma in a second. But I think one really nice way as we going to use our toolbox to have this discussion, I love this simplified approach of saying, let's just start by filling a bucket. And so I was working with a shop about 1.7 billion, asset sensitive, pretty meaningfully asset sensitive, and hesitant. They're stuck here. They're stuck, and their culture has always been short-term loans, and they're losing some deals. And so finally, the lender said, so what I'm hearing is that, we could fill a bucket of $25 million on, some of these structures today. Right. And so how do we build that bucket? A lot of times when we go through this exercise with clients, the bucket may start at 25 million, but then we find out, okay, let's, come back 90 days from now. Did we execute? How did it impact our risk position? And what does it look like today? And we find out the bucket's 50 million or 75 million, right? Think about pricing on these structures. What's interesting, because the yield curve is pancake flat, okay, actually a little inverted, right? We do hear in some circles, not everyone, but some circles say, the good news is not as many people are playing in the 7 and 10 space, so I could probably get an extra 25 basis points versus 5-year structures. So that might be a better risk-adjusted return given how flat the yield curve is. Talk about core deposits and tell your story and leverage that. Also, as a sidebar discussion, review upcoming loan resets. And the thought here is that with borrowers clearly, understanding that rates are going to go higher, who are the ones coming due 12, 18 months down the road? Do we know those credits, and what potentially could be at risk for refinancing? Another really nice action item to tell your story about capacity on fixed rate assets is to say, just pull up your repricing gap. You can do this in 5 minutes. Pull up your repricing gap and look at all assets that are repricing and maturing outside of 5 years. In this case, $77 million. Then you want to compare that to the good stuff, right? Well, how is it funded, right? Checking, savings, capital. Again, non-rate sensitive, balances that grow in a tightening cycle. And this is, I know it's kind of back of the napkin, but it does tell a story in that, they're not even utilizing a third of their core funding to support long-term asset growth. Okay. And even if you want to haircut this thing down by 10 or 20% for the surge, the number is still big. So it helps you get to that, fill a bucket type of number. Here's that case study that I mentioned in the beginning of today's webinar. And I ran this for a client, an ALCO meeting last week, actually. So you can see this is, again, over to the right, this is status quo. This is what they look like today. $700 million balance sheet. Okay. They've got exposure to rising rates, up to parallel, up to flat. They've got some exposure to rising rates. Okay. So I wanted to think about dynamic betas. I wanted to be more realistic. Okay. So first thing I want to do is say, what if we, lag deposits for the first 75 basis points of Fed tightening? They had an even greater lag last go around, but I wanted to start at 75. And you can see how that really, impacts and changes the sensitivity in year one. I'm not doing this just to paint a better picture. Yeah, again, I'm trying to be more realistic in the dynamic betas, that really play out in tightening cycles, and say, all right, well, although it softens my near-term exposure, I still have, exposure to the flatten up to thereafter, right? Think about 2023, right? But at least kind of gives me a new kind of level set there. And then I wanted to get into the next layer. I just flipped it, kind of came quick. I just flipped the slide and say, okay, now my over to the right, that's kind of my new sort of base. That's my lag scenario. Over to the left to say, can I fill a bucket of $20 million of commercial growth? You could think of this as mortgages. You could think of it as bonds, ag loans, right? And I'm going to fund this short. And how does that impact my risk profile? Clearly, it's going to say I'm going to have a higher level of run rate of net interest income, kind of maximize my spread today. And yeah, I might still have that exposure going into year 2 and 3. But do I want to, then we have the conversation, do I want to have most flexibility on the funding side throughout this cycle? Or do I want to layer in some term funding to help support that? Right. But kind of cascading this, dynamic of pro formas gets into a point saying, okay, I can do this, and here's how. These conversations happen at the ALCO meeting, and we can have the best reports in the world, but if we're not getting to the level of being less backward looking and more forward looking, that's a common thing we hear from new clients. It's all being wasted, right? And so last slide for today, which is, how do we reframe the ALCO meeting to be more forward and strategic, thinking? And this slide came to me about 1.5 years ago from a new client meeting. Built in, an ALCO model. We did an in-depth deposit analysis, had a pre-ALCO strategy call, ran a bunch of pro formas, had the meeting scheduled for about 90 minutes. CFO called me the day before and said, Joe, we got to get this thing inside of 30 minutes. I said, great. We put all this time, energy, and effort into this. I go, well, you're not going to get your return on investment if we're just, talking 30. I go, why 30 minutes? Joe, people nod off, man. They lose attention after 30. I said, well, let's stick to the 90, and then we can, maybe reset, moving forward. The meeting went 3 hours. And it had nothing to do with us going through reams of paper. In fact, the deck was only 35 slides because we rolled up our sleeves. Everybody was involved, and we left the meeting with probably 3, maybe 4 strategies that really changed the trajectory of earnings. So start the meeting with key issues. So a key issue today might be, I want to start outlining my first steps on deposit planning. It might be, I want to define a specific plan for my cash position and getting to work over the next 6 months. Not loan to deposits did this, balance sheet did that. We'll talk about all that stuff, but at least starting there gives us that narrow journey to leave with executable strategies. Condense the deck. This is, these ALCO packages have gotten, too dense. Doesn't mean we have to present 100 pages to ALCO. Target 30 to 40 slides. Initiate discussion, right? We need to hear from the frontline folks. I need to hear from lenders today. I need to talk about pricing, deal structures, competition, where we're winning and losing deals. We can then react as risk managers to what they're saying. Retail is going to be leading this discussion very soon at ALCOs. Run pro formas. I showed you a number of examples today. Power up with data. So the question I'm going to ask you is that, are you going to be making deposit decisions today based upon gut or what your data is telling you? Focus on less on where you're going and where and where you're really, or where you've been, and more on where you're going. I think that's where we can help. And then finally, tell a story. I've always looked at ALCO as, telling a story. What do we want to get accomplished today? And how do we take our team on that journey to lead with executable strategies? So with that, yeah, man, I was fired up today. I'll kick it back to Susan and the team and take your questions. Please ask questions.
You were fired up today. Good presentation. Thank you. Yeah, we have a few, excuse me, we have a few questions here for you to start off with. And anyone that also has questions, please go ahead and put them in that Q&A box and we'll pose them to Joe and get them answered for you. So Joe, our first question is, most of our variable rate loans are linked to New York Prime, but some of our hedging options may be tied to 1 month SOFR. Is there likely to be a big difference between how fast SOFR rates and New York prime rates increase? Which index would be best for us to tie our rate hedges to?
Oh man, I wish my audio got cut out. That's a good question. That's a tough one. What a tremendous question, right? So you're talking about basis risk, one of the key pillars of interest rate risk. And because SOFR has kind of taken over as this new index, and I'm thinking hedging, I'm thinking it's liability costs. Wow. You would expect that, I mean, is there a risk? Sure. We've never taken SOFR through a tightening cycle, right? And, obviously liquidity in SOFR is building, and that shift has happened, is starting to, or is happening from LIBOR to SOFR. And you would hope that, that basis risk would be minimized. I don't know if I'm the capital market specialist to opine on that. But I understand where you're coming from. And, I think if you're using, an index to hedge, I'm thinking, I don't know what the hedge really is here. But SOFR and effective Fed funds is, those are the indices that are, I think, being used widely, in the marketplace. But that's obviously one to closely watch. And I wish I had a crystal ball to tell you something better, but that's an awesome question.
It is an awesome question. He adds that interest rate swaps are the hedge.
Receive fixed. Oh no, is it receive float, pay fixed? I'm watching the feed.
Yeah. Yes.
Yeah. Okay. So you've got some floating rate loans that they're gonna benefit as rates go up. You've got some protection on swaps where you're protecting against rates up too. I'm assuming there's some sort of funding, piece that you're swapping out. Maybe it's home loan bank advances. So the thought there is if SOFR goes up more than prime does, obviously there's going to be a little bit of a disconnect there. That funding, or actually if it moves slower, then you're going to get less benefit. Or I'm sorry, it's going to be the opposite. See, I'm already tongue tied, and my brain's wrapped up in a pretzel right now.
Swaps will do that to you.
Yeah, swaps will do that to you. It's an interesting thought. I don't think we saw much basis risk so far through the first 25. But that's a good one.
Jordan, I'll add that we have a SOFR based advance that we just came out with that adjusts daily. So we'll follow up with you.
Oh, it's received floating on the. Is it a last of layer swap strategy? Transitioning fixed rate loans to variable. I got it. So there could be a disconnect between prime and SOFR. Interesting. Yeah, no, that's interesting. Got it.
Yeah. Well, we'll tell you about our advance. We'll see. We'll talk with you about that. We may have some information to share on that too, Jordan. We can talk with our capital markets group on that basis risk stuff too. So, all right. We have another question. If inflation persists that squeezes the consumer's balance sheet or budget, what are your thoughts on a potential increase in betas compared to prior cycles?
Oh, yeah. So, okay, inflation persists. So kind of what's being played into the market today. So say the Fed, instead of doing its normal 25, it goes up 50 in May or 50 in June. And so will betas react differently because of the faster moving Fed? I could, you could also make an argument because there's so much liquidity in the system that betas could be slower. Right? The way we look at betas and deposit rate lags is really from a spread to a market index. And, generally a money market spread lag is about 30 basis points. Checking and savings are closer to 50 basis points. So yeah, if the Fed does get to 1.25 by June or July and close to 1.5, things are going to start moving. It's going to happen. And it's going to be, and that's why I kind of brought it up, how critical it is to say, well, how are we going to react in that environment? Let's put ourselves right there. Fed's at 1.5 in July. Now we still got 5% of our balance sheet cash. What are we going to do? It's when CD rates start to take off. How are we going to play this thing out? Have we looked at our biggest, customer balances? How much of those changed? If we're seeing attrition, how do we react? Is it attrition because we're losing core relationships, or is it attrition because we're just losing some of that surge off the top that we knew was going to leave? I could see this thing playing out. Hopefully I come back, late summer and we get into more of a liquidity and deposit discussion. What else?
Sounds good. A couple more. Any particular adaptations for an institution which is at or near 100% loan to deposit ratio right now?
Tell me more. Adaptations. What does that mean? Any more adaptations? Adaptations for an institution at a loan to deposit ratio. I'm assuming, maybe adaptations to how we're, adapting to this fast changing environment. How are we different, than most? If you're at 100% loan deposit ratio today, you're a lot higher than most. Okay. I don't know what will was that caused because we didn't have the same deposit surge as everybody, or did that happen because we've been, rocking and rolling on the lending side over the past couple of years, right? A high loan deposit ratio today might not be a bad thing, right? It might say that we've got, a lot more loans and investments, and, we've got some positive momentum. If I'm in that situation and I'm thinking like, first off, I got to think of liquidity from a total liquidity perspective. We all had 100% loan deposit ratios in 2018 and 2019, right? I would want to look at total liquidity and how do I utilize the home loan bank as part of my liquidity source through this tightening cycle, because we still need to lag as much as we can. And am I better off pricing up my entire money market base, maybe for 10% of the squeaky wheels, or should I lag that, maybe see some bleed off and then backfill from the home loan bank? If I'm really looking to get aggressive and fund a lot of loan growth over Joe, I'm talking about this and, my sights are on the next 2 years, that, early in the cycle may be the time to go out with that product, to get aggressive. I like more money market specials with the relationship hook. Harder to do that, harder to construct that, harder to sell it, right? But you tend to see, because we track all this, you tend to see some pretty good success rates on bringing in new money, minimizing cannibalization, especially if you're early in the cycle, because you can get out there and make a splash before anybody else does. Then you've got control of the rate. Even if you lock in the rate for 6 months, you got control of the rate, moving forward. So then you can lag, deeper into this cycle. And then you'll have to, tighten a little bit more, but at least you've got that relationship. And then you'll manage it on the way back down. I don't know if that's what they were looking for, but hopefully it answered the question.
Hopefully. All right. The last one we have for right now is, given the possibility of aggressive rate increases in 2022, should you invest in smaller amounts more often and invest in rising rates?
Interesting. Dollar cost average, right? I think that would fit for any rate cycle. Gosh, man, it's so hard to answer these questions because, like, I don't know what you have for cash position. Like, my answer might be different for you if you had 12% of your balance sheet in cash versus 3%, or just depending on your risk profile. Like, if you're really asset sensitive, I might say I would always kind of be in that dollar cost average strategy, right? But if I'm planning on buying, I'll make this up. If I'm planning on buying $5 million a week, do I take a bigger bite today? Do I do $10 million this week? Maybe. If I'm really asset sensitive, I would consider that. I was sending out, emails again to clients this morning that are not even asset sensitive. They're well matched. I think I like that strategy, but I really want to, I need to know the full story. I need the full story. But as you can tell from today's session, I am a proponent of taking advantage of what's been going on in the yield curve over the past month or so.
All right, thank you. One more here that has come in so far. As the younger tech savvy generations phase in and replace the current depositors, do you look for more deposits to move toward online deposit institutions rather than local banks? assuming the mega banks with online presence could offer higher deposit rates.
Holy moly. Right. We just set up another webinar. Jordan, you're killing me, man. That's another great question. That's been the concern in our industry for how many years now? You know, as community institutions, if you look at the average age of our depositors, we track this stuff. You know the answer. And a lot of us are waiting to, I had this conversation at ALCO last week. A lot of us are waiting for the shoe to drop. Right. And, you know, for these balances to, you know, change legacy hands and the risk there. Is that a risk? You better believe it's a risk. And I think this risk accelerated given the last 2 years when people stopped going to banks, couldn't go to banks. And all of a sudden these fintechs, these SoFis, you know, came about. So how do you respond? How easy is it for somebody to, if I want to open an account right now with you folks, and I want to get it open in 15 minutes, could I do it without talking to anybody? How easy is it for your systems to handle that? Right. And what are the product sets? You know, you got to think about this on the business side too, right? That's a big part of all of your relationships. And how does that evolve, right? You got to obviously you got to segment it by consumer to business, but I'm assuming this is part of a lot of strategic planning discussions, you know, when you're looking at 3 to 5 years. And talking about how you can, you know, quickly onboard and relate to, you know, the younger tech savvy, you know, demographic. It's a big risk.
Good question. Something lots and lots of our members are facing. Yeah. All right. Well, that is the last question I believe that we have. So I'll thank you, Joe, for your talk today.
My pleasure.
And we would appreciate everyone completing our survey. We'll place the link in the chat for today. At that link, you can complete the survey. Plus, you can apply for CPE credits for today's session. In addition to that, you can register for our upcoming annual management conference. It will be held in Kansas City, April 20th through the 22nd. If you haven't been, excuse me, you should check it out. We really have it all. We have great speakers, good networking, golf, and entertainment. Members tell us that it's one of their favorite conferences that they go to every year. And any attendees from your institution after the first person get a discount on their registration. So love to see you there. So thank you again, everyone. And thank you again, Joe. Appreciate your talk today and appreciate everyone's participation. And have a great rest of the day.
Thank you. Thanks, everyone.